well and you're all staying safe and staying at home wherever possible and whenever possible, because we really need to play our part in fighting this deadly virus, COVID-19, by doing our best to stay safe, stay healthy, stay at home, all government care guidelines. All right, so this is Wednesday, and it's another opportunity for us to talk mortgages again. And I'm very happy and very excited about talking to you about things that we need to discuss today. In the past couple of weeks, we've been talking about mortgage products based on interest rate options, mortgage mortgages, fixed rates. We've talked about flexible mortgages and offset mortgages and stuff like that. So today we are still continuing on those mortgage products. And today we're going to be talking about two very popular mortgage products as well, which gives us the opportunity to kind of blend in some of the mortgage products we have discussed before, because these two products we're going to talk about today have, elements of those different products, embedded in them. But before then, I just want to give you an update on what the market is looking like in the properties and mortgage markets in the UK at this time. So the biggest news so far is on the official statistics released by the Office of National Statistics on UK house prices. So the average UK house prices, according to the official statistics by the Office of National Statistics (ONS), shows that the average UK house price rose by 1.1% year on year till February 2020, before the whole of UK went into lockdown. So there was a 1.1% rise year on year up until February, and that's official from the official Office of National Statistics. So breaking these statistics down, that's the average UK house price rise. So the average UK house price, based on these statistics, is at £230,000. So the average UK house price stands at £230,000. So when we say the average UK house price, remember the UK is made up of four different nations. So that comprises of house prices in Wales, in Northern Ireland, in England, and in Scotland. Now, breaking this down country by country, nation by nation, Wales recorded the highest rate in the house price increase of 3.4%, and the average house price in Wales stood at £164,000, which is and then it was followed by Northern Ireland. Northern Ireland, the average house price in Northern Ireland rose by 2.5%, and the average house price in Northern Ireland stood at £140,000. And the average house price increase, was the same in Scotland again at 2.5%, and then the average house price in Scotland stood at £151,000. Now, England, unfortunately, recorded the lowest increase in house price in terms of percentage. Percentage-wise, it was a 0.8% increase in house prices in England. But the average house price in England stood at £246,000. So then if you break it down to regions, the east of England was the only region in the whole of UK to record a drop in house prices by 1%. So house prices in east of England dropped by 1% in on the annual statistics year on year up to the February 2020. Okay, so what does this statistic mean actually to us? Just analyzing this, and what are the implications as for house price and how it affects property market. So I was reading the analysis by David Westgate, the CEO of Andrews Property Group, on mortgage strategy. He was of the opinion that this statistics really doesn't really mean much in the scheme of things now, because just like every other sector in the UK economy, the property market or the property sector is frozen. So there's really not much you can do with these statistics now. It really doesn't mean much to anyone unless activities come back to normal, and after the lockdown, and when activities are frozen, then we begin to make meaning, read meaning into these things, and that's when the statistics will start to make meaning. But then there is a warning for those who basically think that, oh, after the lockdown, because you want to buy a property, you think that anybody you price their property and offer them anything, that they will be desperate to sell. You'll be met with a huge shock, because really the feeling is that sellers are not really going to be desperate to sell their properties after the lockdown, and nobody's going to say, oh, the economy is very poor, so we're going to offer you this rubbish amount of money, you're bound to take it. No, it's not guaranteed, and it doesn't work like that, because the sellers are aware that the government puts measures in place to secure people's jobs and people's salaries. So it wasn't like people lost, their earnings or their livelihoods entirely throughout the period of the lockdown. The government guaranteed 80% of people's earnings, and most of these workers, their employers made up the remaining 20%. So it wasn't like during the lockdown you lost all your earnings, therefore you cannot afford to do those. You cannot afford to do that, except you are self-employed and it's affected your business and there is no other means of income coming in. But even at that, the government still did something for self-employed. So basically, they, there won't be that much of a shock in terms of house price movement. Buyers should not expect house price movement to favor them, because really the sellers will not really be in a panicky mode after the lockdown. That's basic. That's what the market is sensing, because the demand is still there. It's just that people are waiting for the lockdown to be lifted. And it's very likely that once the lockdown is lifted, there will be hundreds of thousands of frozen house deals that need to be completed immediately the lockdown is lifted. And then people will be very keen to move on and get on with their lives. Because one thing this lockdown has taught everyone is that, life is there to be lived. When you see people who are dying of this lockdown, you just begin to imagine, putting your life on hold, and then all of a sudden something comes and sweeps that life away from you. So people will be more in the appreciative, mood after this lockdown, to just say, look, if I still got a job, I'm very lucky, and I carry on with my life and I carry on with my job, and I'll live my life, because life is there to be lived. You don't know what tomorrow brings. That kind of psychology and that kind of mentality will start, you know, getting into people's mindset, and they'll be willing to go out there and do things, including buying properties. So the demand will still be there, and the supply is still short. There's still shortage of property supplies, and once the demand is outstripping supply, you know that the price is going to go in one direction only. So do not expect major shock. Also, there is the expectation that the government are going to bring in more stimuli to stimulate the economy. There might be something done about stamp duty. There might even be a stamp duty holiday, basically. And then there is also every likelihood that the help to buy scheme will be extended. And then there will be also some other form of cash injection into the economy, just to stimulate the economy and jumpstart it after the lockdown. So these efforts by the government is actually going to help cushion the effects of the lockdown on the property market, which is, another good reason for people in the property market to be optimistic about what the property market is going to be. In terms of how activities are going to pan out in the property market after the lockdown, it's expected that activities are going to be slow. Market activities in the property sector are going to be slow for the rest of 2020. But by first quarter of 2021, things are going to begin to pick up, rapidly again. So those are the analysis as seen by David Westgate, CEO of Andrews Group, which is a publication on mortgage strategy. And I very much agree with that, because what we are seeing and what we are feeling is not really that people are expecting the house prices to crash after lockdown. People are just waiting for the lockdown to be lifted, and if you are alive and if you are still healthy, you carry on with your life and you enjoy your life and you live life to the full. So if you've got a mortgage offer at the moment, please do not play a fast one, or do not try to play a fast one on the seller by trying to reduce the offer on the house price at the last minute, just to see if you're going to catch the seller in a tight corner and force their hands to sell to you at a reduced rate. It's called gazundering. Now, if you attempt gazundering, it might backfire, because the seller might just get annoyed and thinking that you're trying to take advantage of the situation, and they might just decide to pull out of the sale, and that mortgage offer becomes almost practically useless. And if you do not complete on that mortgage offer, the mortgage products available on the market now may not really be suitable for you. So if you've got a mortgage offer, by all means, please try and make sure you complete on that sale or that purchase while that mortgage offer still lasts. If you got that mortgage offer pre this lockdown, you might probably have had the best offer yet before the lenders will come back and start lending normal again, because a lot of the mortgage products have been pulled out of the market due to this COVID-19, and you are better off just completing on that sale. All right, so let's dive straight into today's topic. We are going to be talking about two mortgage products today. The first one we're going to be discussing today is what we call the discounted rate mortgage. Now, the discounted rate mortgage is a kind of standard variable rates variation of product. So it's an extension, a variation of a standard variable rates mortgage. What it practically does and how these products work is that the lender will offer you a discount on their standard variable rates for a few years. Say if you take out this discounted rate mortgage for the first 3 or 4 years, for example, the lender might offer you a discount on their standard variable rate. So if the lender standard variable rate is 4%, for example, they might offer you a discount of 1%. So for the first 3 or 4 years, you're going to pay 3%. So it means you are saving 1% from the lender's standard variable rate. So you're paying 3% up until that discount expires. Once that discount expires, you are switched straight back to the lender's standard variable rate at the time that offer expires. So if within the time that offer lasted, you were paying that 1% less, and by the time that offer expired, if the standard variable rate has increased from 4% to 5%, you will now be paying the 5%. So whatever the standard variable rate is at the time that that discount expired, that's what you're going to switch back in. So that's how discounted rates works. Now, discounted rates products are really designed to, attract new businesses, just like, the fixed rate mortgage products do. They actually just make life comfortable for you for the first few years, and then you get attracted to the lender, you take their product, and then you crack on with them maybe after the discount period has ended. Now, so if you get a discount from the lender on a discounted rate product, that discount is real in the sense that the interest you have saved in the period of that discount will not be added onto your mortgage. It's not like something that you're giving this discount, and then after that, that's money you didn't pay in the discount period will not be added to the balance of your mortgage and you pay it along. No, it's real. You've saved it. Once that discounted period is over, your mortgage balance as at that time is what carries on with the new rate that you're going to be switched on. So it's a real saving. It's not carried, forward to your outstanding mortgage balance. Okay, so some discounted mortgage products, they offer what is known as stepped discounts. Now, step discount, the way it works is the lender might decide to either increase or decrease the discount as time goes on. So they might offer you 1% in the first year, 1.25% discount in the second year, 2% in the third year, and just progressively increasing the discount for you for the number of years that that discount is going to last. Or they might decide to do it retrogressively. They might start with 2.5% in the first year, reduce it to 2% in the second year, 1.5 in the third year, and just reduce it. So they can decide to structure it in any way, but it's called a stepped approach to discounted mortgage offers. Now there are key things that you need to consider when you are taking out discounted mortgages. One of them is arrangement fees. Now, arrangement fees are very possible, and they usually apply on discounted rate mortgages. The range of the fees vary with the lender. So the lender would, you see it on your key financial information document. The lender will spell out what fees are payable for arranging that discounted rate mortgage for you. Okay, and they are normally non-refundable. Also, there's something called interest rate floor. Now, because the interest rates currently the base rate currently is 0.1%, the lowest it has ever been at. Now, in a very low interest rate regime like this, it's very safe for the lender to put a cap on the minimum amount of interest that is payable on any of their products, so that they don't shoot themselves in the foot like they did sometime in 2009 in the past. So now there is a minimum interest payable. So no matter how much discount you are given by the lender, you will not pay less than that minimum. So that becomes the benchmark, that becomes the threshold of the interest rate reduction that they are able to give you. Because if the interest rate has been reduced to 0.1%, like if the base rate currently is 0.1%, the lowest that it's ever been in history. Imagine that the lender did not apply any minimum interest payable and just said, okay, we are offering discounted rates of 3% off our discounts, our standard variable rate products, and then the standard variable rate product happens to be priced at 2.5%, for example, and then all of a sudden COVID lands, and then the Bank of England reduces the base rate to 0.1%. What it actually means is that if they give you 3%, if you're on 3% discounted rates, the lender will pay you for actually giving you a mortgage, because the interest rate will then be in the negatives. So that's why they apply the minimum rate, the minimum threshold. So that it's called a interest rate floor, so that it doesn't go below a particular minimum interest rate. Also, other thing you have to be aware of is the early repayment charge. Most discounted rates mortgages come with early repayment charges. The idea is to deter you, or to deter the borrower from paying up partially or in full the mortgage balance while they are still within the discounted rate period, and then running off with another lender and taking advantage of that product while you are still within that discounted period, taking advantage of it, and then run off that. So to deter people from doing that, they charge you for paying off the balance early, either in parts or in full. It's called early repayment charge. Now, this early repayment charge could be applied in three ways. They can decide to charge you some many months interest on your outstanding mortgage balance if you decide to redeem that mortgage in part or in full earlier than scheduled. They might decide to charge you the discount that you have enjoyed up to the date you are going to redeem that mortgage. They might decide to charge you that discount, that rate, as a penalty for redeeming the mortgage earlier than scheduled, or they might decide to charge you a fixed interest rate based on the agreement you have with the lender. So that's basically one thing you have to be aware of, that there could be early repayment charges on discount rate mortgages. Also, the lender might want you to make some additional purchases compulsorily, not necessarily with the lender, but they would want to see things like buildings and contents insurance purchased, and they would want to see things like life policy, life insurance, or they would want to see, things like mortgage protection insurance, just to, put them on the safe side and put their minds at rest that no matter what happens, their stake in the property is secured and their security is secured as well. Okay, now the other thing you have to be aware of is in the area of increase in standard variable rate. Now, if the standard variable rate of the lender increases from say 4% to 5%, yeah, that increase will still be applicable to you the moment you come out of that discounted period. But I want to clarify one thing here as well. The discount you're enjoying is based on the lender's increase on the lender's standard variable rate. So if you're entitled to 1% discount of the lender's standard variable rate, even though you're within that discounted period, if the interest rate goes up on the lender's standard variable rate, that interest rate is the basis upon which discounts will be calculated. So if you enjoy 1% discount and at the time you took out that mortgage product, it was 4%. If the standard variable rate was 4%, that 1% discount means you're paying 3%, yeah, within that discounted period. Now, if the interest rate goes up to 5%, what you will be paying will now be 4% instead of 3% because the basis of the discount is on the lender's standard variable rates. Okay, so it doesn't mean that because you are paying 3% in year one and you're entitled to 1%, if the standard variable rate goes, so there is no insulation, there is no protection for you from the increase in standard variable rates of the lender. So that's the basis of that discount. Now, the other product I want to talk to you about today is on hybrid mortgage. I'm going to rush through this one very quickly because there isn't really much to talk about. Now, hybrid mortgages, the way this works, that hybrid mortgages are a mix of two different mortgage products. Now, it can take different forms. Now, one form it can take the form of part repayment and part interest only. It's called part and part. So you can arrange a mortgage that's part of it, maybe 50% of it is repayment, 50% of it is on interest only. But then you must satisfy the lender's criteria on interest-only mortgage product before you take that product. So it's subject to you satisfying the interest-only criteria. And one of the major interest-only criteria is showing and proving and demonstrating to the lender that there is a vehicle that you have in place that will pay the capital on the mortgage when the interest-only period ends. How do you intend to repay that capital? So you have to demonstrate that maybe you have an investment somewhere, maybe you have, cash, that somewhere you are sure that that investment will yield you enough to pay off that. So you just have to demonstrate that there is a vehicle put in place to repay the capital when the interest-only period ends. Okay, the other form it could also take is a mixture of different interest rate products. Now, the borrower can arrange half of the mortgage, say, on fixed rate basis and half of the mortgage on a discounted rate basis. So that's another form of a hybrid mortgage. You can arrange, say, half of the mortgage on fixed rates and half of it on discounted rates. As long as it's a combination of two different mortgage products or two different mortgage elements, that makes it a hybrid mortgage. It's possible for you to arrange that mortgage on partly fixed rates and partly fixed rates and partly discounted rates. That's also a hybrid mortgage. And then you can what this does is that if, for example, you arrange it on partly fixed rates and partly discounted rates, it enables you to lock down your interest rate for the fixed rate period. So that fixed rate element of your hybrid mortgage enables you to lock down your interest rate for that period. So if you fixed it for 5 years. So for example, you took out a £200,000 mortgage and you say, okay, £100,000 of that mortgage is on a 5-year fixed and £100,000 of it is on a discounted rate. So that's part of the mortgage that is on a 5-year fixed. Means for the 5 years that you have fixed it, no matter what the interest rate does, you are immune to the volatility of the interest rate. You are protected against the volatility of the interest rate. You've locked it down. That's what they're going to pay for that 5 years on 100,000. So the other 100,000 pounds enables you to take advantage of reduction in interest rates if that so happens. So if there is a reduction in interest rates, you will enjoy that reduction in that discounted rate of the standard variable rate product that you have taken. Because like we discussed earlier on, discounted rate is a variation of standard variable rate. So that will enable you to enjoy, kind of best of both worlds. Okay, so some other possible combinations of hybrid mortgage that you can look at this. You can have a fixed rate and discounted rates mortgage, which we have talked about here. Excuse me. You can have a fixed rate or capped rate mortgage built into one mortgage product. You can have a discounted rate, a tracker mortgage built into one mortgage product to become a hybrid mortgage. You can have a fixed rate and tracker mortgage built into one mortgage product as a hybrid mortgage. Okay. Now, in a hybrid mortgage, some lenders do specify in what proportion each product should come. They might say, okay, you are going to have 60% of it fixed rate and 40% of it discounted rate. The lenders might be the ones specifying in what proportion and what percentage each product element will make up the hybrid mortgage product. Some lenders are more flexible. They will allow you to choose in what proportion you want it to be. And so however the lender presents it, if it's a flexible type, you make your choice. If it's a lender that has fixed it and if it suits your mortgage need, you make your choice based on that. Now, most hybrid mortgages, early repayment charges do apply as well as arrangement fees as well. So just like the discounted rate mortgage, because there is a benefit there for some time, the lender is most likely going to apply an early repayment charge on top of it so that you do not take advantage of the benefit within that short space of time and then redeem the mortgage and disappear to the disadvantage of the lender. So they put these things in place to checkmate such abuse and such excesses. Okay, so if you intend to make a part redemption payments, they can choose to apply the payment element that has the least early repayment charge. Say, for example, you have a hybrid mortgage of a fixed rate and a discounted rate, and let's say the fixed rate element has a lower early repayment charge. So if you want to make a part payment, a part redemption, you can choose to redeem that fixed rate product element of the hybrid mortgage because it has a lower early repayment charge than the discounted rate element of it. So it's your choice. You can choose to repay that in that format. Okay, so I hope this has been useful to you, and I hope it's giving you a better idea of what discounted rate mortgages and hybrid mortgages look like. These are the basics of that. So, but remember that the choice of mortgage products down to your individual circumstances, your needs, and your objectives. And that's why when you come to us to discuss your mortgage needs, we take you through a journey of finding out exactly what product best suits your individual circumstances, before we recommend mortgage products, and we must justify why we are recommending that. That's why we're a regulated business. So please feel free to give us your feedback on how helpful you have found this content. Please, your feedback is really, really important to us. We want to know exactly how you feel about this. But if there is any topic you would want us to talk about or any questions you have on mortgages, please feel free to type that question in the comment section of whatever platform you have seen this production or you have seen this session, and we'll be more than happy to attend to that and answer those questions. So once again, thank you very much for watching. Thank you for being part of this, and we look forward to seeing you again next week. I'm still Ikenna Umezudike, Director of Modesty Financial Consultants Limited, based in Luton, the United Kingdom. We are specialists in mortgages, financial advice, and we offer financial investment advice as well as business loans and business finance. Get in touch with us and let us see how we can help you. Thank you. Stay safe. Take care. Goodbye and God bless. Cheers.